All right. Morning, everyone. Let's get going. Okay, so last night turned into a bit of a non-event. You can see the S&P. I mean, for the most part, when we spiked up right at the opening, the market open, and just trended sideways for the most part for the entire day. I mean, um, all the markets just probably putting in a little consolidation. The one thing that I would mention is just there, the S&P, where you can see it ticking around at its highs of the sessions yesterday. That was within a half a point or a point of new all-time highs, and the same level I think that we've been rejected at twice before. So, I was kind of watching things quite closely there to see if we were going to be able to make a push to the upside. Obviously, we didn't yesterday, but you got to remember where we are in the big scheme of things. We're just below. I mean, we're literally about six points, if I'm not mistaken, below all-time highs, 7 points below all-time highs on the S&P. So, even though the market's kind of been chopping around, it hasn't been a pretty, move. We haven't been, trending or anything like that, but we are literally right there, potentially consolidating to break out to new highs. Not saying that that's what's going to happen, but that's just how close we are. Okay, we saw factory orders yesterday, a really nice number, biggest monthly gain in 8 months. It's jumped by 2.1%. We saw at the beginning of the session, we saw U.S. Treasuries leaking down south of 210 early on in the session. And then when we saw the factory order number, we really saw the Treasury numbers turn around. Right now we're trading at 214 and a half. This is, like I said, maybe the sixth day in a row that we've pushed higher on Treasury yield, 10-year Treasury yields. That yield curve starting to steepen here, and I think definitely, getting close to forcing the Fed to hike rates if we continue to see that yield march higher. We had Warren Buffett, just some comments from him out of the meeting over the weekend. He's saying that stocks are on the high side of valuations, and he said they won't look cheap after an interest rate hike. I've had a bit of a bearish undertone on the market for the last few months. If you guys, have been able to notice that, you can't just go out and just throw out, pure shorts under an environment when the market's, not, it's not, giving you the negative undertones on the patterns. But I think what's been really interesting the last couple of days, and especially over the weekend, so you had Bill Gross from PIMCO coming out with some terribly negative stuff. You had David Tepper, one of the most respected hedge funds in the world, terribly negative. Jeff Gundlach, one of the best bond managers, if not the best bond manager in the world, becoming terribly negative. You had Carl Icahn come out yesterday, really bearish. So there's I think it's the Son Investment Conference, one of the hedge fund investment conferences going on right now, and the rhetoric is not good, to say the least. And you don't get very many spaces where there's so many major warning cries from the smart money out there. So I think it's something to pay attention to. The fact that the market's still running when these guys are turning bearish, it doesn't mean that they've shorted anything, just because they're bearish. I think it's something to pay attention to as we move a little bit forward. It's starting to seem like it's becoming across the board consensus, and that could actually squeeze us higher potentially in the short term. But let's just we'll keep note of it as we go along. All right, in Asia overnight, pretty much a non-event outside of Shanghai and Hang Seng, which got pummeled. Shanghai really got beat up hard. Not really, the government came out and said that they warned the public not to be irrational in their investing. Obviously, they're seeing bubbles forming in the Chinese stock market. It's the run that they've had there relative to what the economy is doing is probably one of the most unprecedented disconnects that's ever been in the history of investing, and it just shows you what's able to happen when you kind of force lending. Anyway, the Australian Central Bank also came out, cut interest rates down to 2%, if I'm not mistaken. We had the market there that's just trading higher earlier in the session, but more or less finishing flat toward the end of the day. That interest rate cut was really telegraphed, so I don't think that there's anything too much to price into that. You can see that not much happened in the Aussie dollar this morning. All right, chart of interest today. Everyone talks about the sell and may go away scenario, and just to, for the guys that aren't real market historians out there, to kind of throw a little proof in the pudding here, you can see that if you're long in all months in the gray, that's the chart in the gray. If you long only January, February, March, April, October, November, and December, that's the chart in the green. So you can see, well, shit, you didn't underperform that badly being involved long all months. And it's not that the other months are net losing months. It's just that the opportunity cost of kind of being involved. So when you factor in May, June, July, August, and September, historically, going back, I think this goes back for the last 20 years, you've actually had just slightly negative returns altogether on those months. So there's not really, the market hasn't paid you for taking the risk and being involved in stocks in those months. Therefore, the saying. And if you really go back into history, there's a real reason why this sort of cyclical activity happens in stock markets, and it all kind of started with farming, and that was, typically most of the farmers were only getting paid for the crops toward the end of the year, and then they had a lot of money to kind of deploy into the economy and to pay workers and do all those sorts of things, and then cash would obviously dry up toward the second half of the year until they got paid for that next round of crop cycle. And that was really the effect, and why it's been like that historically. Why it continues to be like that is not, I'm not 100% sure, because obviously that doesn't make as big of a difference to us as it used to. All right, moving on. Corporate action. Nothing to speak of today that I know of. Like we said, we had the Australian interest rate cut down to 2%. UK construction PMI coming out today, 10:30, and then we've got a bunch of data out of the States, trade balance, market services PMI, ISIN non-manufacturing, and then we've got UK Halifax house prices. I think that's only in a few days. All right, I don't know how that made it on there. All right, let's get into the maps. First thing that we want to look at this morning is the German DAX. So we did sell off the top of this DAX here, and relatively nicely. There's definitely some neckline up here and what looks like a bit of a head and shoulder in the DAX. We dropped that neckline rather convincingly about 3 or 4 sessions ago. And yesterday we really bounced up to kind of retest it. I'd put that level somewhere between the close, this close here in the middle of April at about 11,685 and somewhere where we closed yesterday. So somewhere in that range is definitely where the neckline is, depending on how you want to draw it. If you look at this in the hourly, it's different. I would probably just take it from that low close at the number that I just called out, call it 11,685. If we start to turn down here, and especially if we can take out the recent lows, then I think this pattern can complete itself, which is a relatively a nice move potentially setting up. It would be about 750 points to the downside from the neckline, which would put us south of 11,000. So just keep that in mind. Have a look for that in the next session or two. If we start to turn down today, if we can take out the recent lows, I think we can complete that target. And the thing's been so oversold it needs to do it anyway, or so overbought it needs to go anyway. All right, next one we're going to look at is the pound rand. Okay, so this is the GBP ZAR. All right, and what I like to look at, there's a couple ways that we can look at it here. One of this, you can look at it in kind of a horizontal fashion, and I really think that that's where the main level is, which is right at about 1850. As you can see there, we need a close below 1850. This is on the daily 5-year here, so we're looking. This is a consolidation that happened from going all the way back to January of last year to now. To me, the level is at 1850. I think you can, potentially you could draw this a couple different ways, but to me it looks very convincing at 1850. If we get a close above 1850, and I think we can really see a nice move, weaker on the on the rand, obviously stronger on the pound, and we can probably make a move for almost as much as a buck 50, a rand 50 to the upside, which would target 20 rand to the pound. Okay, so that's potentially a very significant move coming there in the rand pound if we close above 1850. Next one we'll look at on the local side is Standard Bank. So let me just take this down to 30 minutes. And so you can see the real consolidation that we've been having here. Definitely there's definitely some sort of level here at about 170, but I think as well 172 for the more active guys. If we drop 172 today, and we tried to drop it yesterday a couple times, couldn't hang down there for more than a couple seconds. If we drop 172, then I think we could really start to break out of this consolidation, but especially 170, the last level of support. If we drop 170, then I think you can go back and look on the daily, and we can really have some consolidation. So if we look at it here, our two levels are right there, 172 and 170. So like I said, if we drop 170, I think we can probably come back down in here and potentially even fill this gap down to where we broke out of, maybe around 162. All right, next one we'll look at is Kumba. Now this is not convincing at all. I'm just throwing it out there. It's like kind of ones to watch out for. Either way you look at it, 180 is a level. We talked about this the other day when we started turning up on Kumba. We talked about this thing getting up to resistance of 180. It got basically exactly there, turned down the other day below 160, and now we've started to grind back up. We're starting to look, potentially like a little bit of an inverse head and shoulder here. If we just carry on in the next session or two up to 180 and then take it out, it'll definitely look like a nice inverse head and shoulder setup, which would take us up to the target, which would be all the way up here probably, 230, 240, somewhere up there. It'll be quite a big target. So, but 180 is the major line in the sand. If we fail 180, and I think if we start to turn down, we would need to see it take out the lows of the other day for us to really move back lower in Kumba. Right, Naspers, we're still looking at the daily here. So there's a level I would throw out to be around 1810 to 1820. So you can see there it's maybe 1820, then running it maybe just a little bit lower and encompassing the bottom end of this wick, which is the low of this entire pattern. Somewhere between 1810 and 1820 to me is where I would throw the level out in Naspers. There's a very good chance we could come into support. Tencent down 1.3% as we speak in Hong Kong. So, if we're looking at that, factor that price movement in this morning, that would take us very close to these support levels. And it's really underperformed of late. I think it needs to show a little bit of, it needs to prove itself a little bit at some of these support levels. The last one we're going to look at is Alibaba. And I want to look at Alibaba in the States for a couple reasons. So we've seen really kind of a rollover of late in a lot of the Chinese, and certain of the Chinese foreign listed stocks, especially the Chinese tech stocks, and even the real high flyer social media stocks in the States have been hit over the last 2 or 3 weeks. Especially after they've reported earnings, with the exception of Facebook, there's been a lot of disappointments. There's been, you've had Twitter, you've had LinkedIn, you've had Yelp, you've had a lot of these high-flying, new online tech, stocks that are trading at major multiples, especially the social medias, have really been struggling on the earnings of late. So I think, Alibaba is another one, the high flyer tech ones. Baidu in this, which is a Chinese listing in the States, is kind of the Chinese Google. They've all been struggling. So this one, I also IPO'd recently. I just think that this is very important to keep an eye on for our stocks like Naspers, and just for the general leadership in the market, the leadership in the States, which is obviously the global leader in all financial markets, has been coming out of two things. It's been coming out the tech sector, and a lot of the high flyer social medias and that sort of thing, and it's been coming out of the biotech space as well, which obviously includes your pharmaceuticals and your medical technology stocks. So when you encompass those two things, if we lose leadership from either one of those, and especially both of those, then that could really be a telling signal that the leadership, from the overall market leader is dead, or for the time being needs to correct, and therefore maybe we start to see a correction. I think Alibaba is a great one to watch. Remember, this thing IPO'd, if I'm not mistaken, we IPO'd in the 70s, somewhere in the high 70s. When we opened up, you can see first day of trading, we traded just south of 100. It settled in at around 94. These guys they made a nice 20-odd% gain on the IPO. I think that right now we're trading very close to IPO price, and as we drop there, to me that's a big negative market signal. I think to an extent you can say that there's been some sort of support that's been lost here around 82, but if we drop at 80, which has been the low of the entire time, and this consolidation period, to me it's a little bit more of a market signal, I guess, than people are paying attention to. I think it's negative for a lot of reasons, and I think that you can look at these for leadership, even into our market in terms of the index and that sort of thing. And that's all I got today, boys and girls. Good luck out there.